All right, everyone. So welcome to Chapter 2 here of the Warrior Pro classes. So in this class, we're going to talk about risk management, which is very topical for today because today happened to be my biggest intraday P&L swing that I've ever had. I was down at one point over $100,000 and recovered it. And my finishing P&L today is $127,000. Now, I don't like to have days that swing that much. I've said and mentioned yesterday, I think, in Chapter 1, that generally I don't want to have a red day where I'm losing more than I would make in a good green day. Well, this week has been pretty unusual. We've had a crazy amount of momentum in the market. I was up a little over 500,000 yesterday before I finished up at 477, which is a crazy, crazy day. The day before was over 200,000. So we're in a market right now where heightened levels of volatility, if you trade something going the wrong way, almost instantaneously, you could be down with the type of size that I trade, 50 to 75 or 100,000 shares. And so risk management ultimately is key to long-term success as a trader. And so let's talk about that here in Chapter 2. I like to hit this one early in our Warrior Pro classes because, in the starter classes, we focus mostly on foundational concepts and things like that. And I have the just general disclaimer of don't trade with real money until you've, made money in the simulator. But now as we're getting into the pro classes, before we get into strategy development, which inevitably will encourage some of you to start, you want to start trading. Some of you may even trade with real money, even though it's not what I would recommend. You may end up doing it. So I want to talk about risk management really early on here. It's not to scare you. It's just to, maybe it is to scare you. I want to make sure we're thinking about this in a smart way. So what we're going to talk about in this chapter is choosing strong stocks as a form of mitigating risk. We'll talk about profit loss ratios. We'll talk about target percentages of success. We'll talk about the breakout or bailout approach. We'll talk about 9 different types of risk. We'll talk about some of the reasons that most beginner traders fail. We'll talk about the gambling mentality, which is the elephant in the room perhaps for some. And we'll talk about the fear of missing out and revenge trading. So sort of, gambling mentality, fear of missing out, revenge trading. These are all, emotional types of behaviors, and emotions can play a really big role in our trading, to the point where someone that's so emotionally responsive could be potentially unable to ever trade consistently profitably because they keep getting in their own way. I'll tell a lot of stories during this class, not just Chapter 2, but just across the whole small cap course. And I do go on tangents. Over the years, I've met so many students. I have sort of so many different stories about people that have struggled. And I remember one student, just as a quick little anecdote, that he was an older gentleman in his 50s, I think it was. He had kids. He'd had kind of a long career, was a freelancer, so self-employed. And he kind of got into trading sort of as a hobby. But for him, he really, really struggled with the search for the Holy Grail. He was always emailing me these crazy looking charts. I mean, I don't have any examples, but, he would have let's just say, for instance, he would have a chart that was something like this. And I mean, I know I draw a lot of lines too, but it was like that. It was just like a freaking spider web. And he would be like, do you see this? Anytime you get this crossover right here where these two lines cross, that every single time, if you had taken that trade, you look at this, you would have killed it on this one. You would have killed it on this one. You would have killed it on this one. And so one of the things I learned about him was that he was so afraid of losing that he was searching for a strategy that would be right 100% of the time. And rather than face his fear of loss and try to deal with that emotion, he just it just sort of kept him on this spiral doing something else, almost without even realizing it. Another story, there's this parasite that affects, I think it's sheep, and it lives inside ants. And ants, without knowing why they're doing it, will crawl up the top of a blade of grass so they can get eaten by the sheep or the goat so the parasite can infect the animal. So they are completely hijacked by this internal virus, parasite, whatever it is. But, I think in some ways we can become victim of that as well. We can become essentially, our behaviors can be based on some underlying pattern or some underlying fear that we don't even maybe recognize or acknowledge. So as part of this entire Warrior Pro course, spending some time and looking within and trying to figure out whether or not you are having something like that you need to focus on would be important. As you know, Ted and Diane joined us in chapter 14 of the Warrior Starter course. They both do one-on-one mentoring and coaching for Warrior Pro students. They only do it for Warrior Pro students. Let me see if I can get you their website. Let's see. Does anyone have a link to it? I don't have. Let's see. So, in any case, the coaching with them, it's not something that we include for free. If you decide you want to do coaching with them, you would have to sign up for that directly with them, and pay for that at their hourly rate. But it's just something that we make accessible to you because of the fact that this is such a real struggle for so many traders. So, here it is. Thanks for posting that. So I'll just give you the link here for Ted and Diane. Let's see. Here you go. Okay. So wisemindtrading.com. And there's a quote from me. So I've been working with Ted now for over 10 years, I think it is. Gosh. Anyways, he's been so great for me. So some of these things, if you struggle to kind of work them out on your own, it might not be a bad idea to, schedule a session and see if you can kind of, work through that. So, all right, let's get into risk management. So why is this important? Well, risk management, no doubt, is critical to long-term success as a trader. I have had my fair share of huge losses, unnecessary losses, where I got smoked and crushed. And if you have too many of those, not only can they blow up your account, they can blow up your emotional confidence, and they can knock you so far off center that it could feel almost impossible to recover. Now, I don't believe that it's ever impossible to recover, but you don't want to put yourself in that situation. So I would say an inability to manage risk is the leading cause of failure for day traders, although it's also probably worth noting that an inability to have the discipline to follow the rules of your strategy would be a second leading cause. So if you fail to plan to fail. In other words, if you don't have a strategy, you're probably going to be losing money as a trader. So risk management is number one. And no, day trading is not low risk. We maybe wish it was, but day trading is over here on the other side of high risk. So one of the things that I like to say a lot is that traders think about risk and gamblers think only about profits. We have to always ask ourselves, how much are we risking? And, today on a couple of my trades, I was risking far more than I realized due to a couple of the risk factors that we're going to talk about in a moment. So when you're trading, while you may take, let's say, 5,000 shares, and you may say, okay, my max loss is 10 cents, in reality, if that's a mental stop and all of a sudden it drops down 50 cents or $1 a share, suddenly you're 10 times below your max loss. Maybe it's halted, maybe there's something else. And now it didn't really matter you had a mental stop because you've lost far more than you planned. So having a mental stop is a good starting point, but by itself, I could have a mental stop right now for, let's look at GameStop. So if I bought GameStop right now, 10,000 shares at $29.95, do you think it's realistic that I have a 5-cent stop on that? Hey, I'm only risking $500 with 10,000 shares. Yeah, right. No, you're probably risking more like $100,000. So your stop has to take into account the market. All right, so we'll get into that a little bit more. But if you're going to take, 17,000 shares and you're risking 10 cents at $1,700, you better make sure you stand to make at least 20 cents. So when you think about the risk and how much you're truly risking, sometimes it requires a little bit of a more honest assessment than we might be initially willing to make or initially able to make, because we all can fall victim to the confirmation bias where we say, this is going to work, and you just get your head set on that. So regardless of whether you're taking 17,000 shares, 1,700, 170, or 170,000, You need to have profit loss ratios that are sustainable, and ultimately you need to have a percentage of success that's also sustainable. So these are the 9 types of risk that I want to share with you guys today. It's not to say that there aren't possibly, more, but we'll probably talk about more sort of, off the cuff as we go through the course. But these are 9 very obvious ones. So we're gonna go through each one in more detail. So if you want to write them down right here, you're welcome to, or if you want to just kind of write them down as we go through each one. But we're going to begin with exposure risk. Then we'll get into float and volatility, distance from stop versus time share size versus profit target. We'll talk about halt risk in a little bit more detail, allowing fear to prevent you from following your plan, the impulse to double down, the impulse to try to revenge trade, following people on social media, chat rooms, Reddit, wherever it might be, and improper position sizing. Okay, so number 1, exposure risk. I'm going to read this out loud for you, so I'll just do the side-by-side camera. Let me turn my light on because this kind of is a nicer, there we go, that's nice. All right, and so I'm wearing my pasta shirt today because I was trying to do the impossible, which was recover from a pretty big loss early this morning, and I was fortunately able to. All right, so exposure risk. Your exposure risk is calculated by the amount of money you have in a trade multiplied by the amount of time you have in the trade. So your capital at risk is simply, 10,000 shares at $100 a share is $1 million, right? That's $1 million of capital risk. But then your exposure risk is, okay, I've got $1 million on the line, and now if I'm holding this for 12 hours or for 24 hours or for 5 days, my risk therefore is significantly higher than if I take that same trade and I'm only holding it for 5 minutes. And this is relevant because as day traders, we're able to mitigate that exposure risk by holding stocks for very short periods of time. Anytime you're holding a stock, you inherently have the risk that news could come out that's bad, that it could get halted, that there could potentially be a secondary offering, or just that, there's like a flash crash or something really crazy happens. So I never really like to take a trade and walk away from my computer. I always try to be like right here dialed in. And so my exposure risk, and in general for day traders, is limited in time, but not limited in capital exposure. So we'll talk about the capital exposure more from the perspective of the times we're really thinking about it are when we're concerned about stocks that could get halted on a T12, which we'll talk about in halts, could get halted pending news, or are at risk of secondary offerings. Those are the times when I'm really thinking about the total amount of money I have in the trade. But right now, if I wanted to take a trade on Tesla, for instance, let's see, the price on Tesla right now is probably like 900. So 800, I could take a 3,000 share trade on it, and it's $2.4 million. And to be honest, while it's true that capital is at risk, it's also true that I own 3,000 shares of a real American company. And those shares have value. So yes, it's true that we could have one of the scenarios where bad news comes out, this and that. And so maybe I'm risking 5% or 10%, which is, a substantial amount of money on $2.4 million. But all things considered, percentage-wise, it's not, for me, usually going to be a problem. When we start talking about stocks that have risk of getting halted or T12, things like that, that's where you're talking about potentially risking up to 50% of the capital, which is almost always unacceptable because we're not usually talking about, 2-to-1 profit loss ratio in terms of risking 50% to make 100%. So as day traders, and you probably understand this already, but what we essentially do is we take much larger positions than most people would feel comfortable buying for, like a hold overnight. And because we have a larger position with leverage, that 5% move on a stock for us with 4 times leverage could be a 20% move in our, the needle of our account. So we do use more capital, but in short periods of time that allow us to sort of aggressively grow our account as long as we're trading well. So I generally try to keep my exposure risk to under 30 minutes of hold time. I just don't like to be in a situation where I'm holding and holding and holding. It just gives me unnecessary risk. So one of the approaches that I generally will take is what we call breakout or bailout. So if I get in and the trade doesn't work very quickly, I hit the road and I get out. Now, the second level of risk, or the second item here in this section, is float and volatility. And so this is where we look at something like GME, and the reason that it's not realistic to only be risking 5 cents is because this is a lower float stock that is very volatile, especially at these prices, and because of what's going on in the news. On the other hand, I could certainly take a trade on General Motors with 10,000 shares, and I honestly think that I probably could say I'm only risking 5 or maybe 8 cents. It's a cheaper stock, but the float on General Motors right now is listed at 1.6 billion, whereas the float on GameStop is 51 million. So think about how when we talk about the liquidity, there's so much more liquidity in General Motors. I can get in and out very quickly. Tight spreads, a very stacked level 2, lots of orders, whereas GME is a much thinner level 2 with a larger spread, $1 a share right now. But even at $1 a share, you can see how quickly it can go right down to 32 and how quickly it can go right up to 40. So being mindful of the type of stock we're trading is very important. Now, that mindfulness will come ultimately just by looking at the level 2, which is why I do think looking at the level 2 is important, because if you just look at the chart, you know, there are times where stocks that do have, I don't know, you know, kind of nice looking charts with big moves, there are times where the float is quite high, and as a result, the volatility is going to certainly be measured differently than on a stock like this one, for instance, where this one is actually even more volatile than GameStop. We've got 96 by 96.50, but if it breaks 96, we're going back to 92. I mean, in 95, it drops $1 a share, and there's only 1,000 shares there. Look at how fast, just for there you go. Look at how fast that goes to 93.25. So this is incredibly volatile, and you can see just looking at the level 2 that it's a very thin level 2. Now that can be to our advantage. These stocks can move very quickly. As you see, it's gone from $60 to $100, over $100 a share. You know, these types of stocks can be really nice for trading, but only when you understand really the true risk involved. All right, so again, so stocks that have lower floats of under 100 million shares, and certainly ones that have floats as low as, you know, 1 million shares or 5 million or even to 10 million, these are going to be some of the ones that we have to be mindful that when we're trading them, they carry the risk of that quick drawdown, that quick flush. And when we have that type of quick flush, and I'll go here so you can see the whole slide, all of a sudden you can be far below your max loss. So while these stocks offer the volatility we want, it also means that they have increased amounts of risk. If we buy a stock up 50% in a single day, we're buying it at an extreme premium versus its previous day's close. That means we have to be particularly mindful of our max loss on the trade and honest with ourselves about what that really is. So imagine rock climbing, just as an analogy here. So imagine you go out rock climbing, you're outside, and you know, Uncle Steve says, "Hey Ross, do you want to go rock climbing?" And I say, "Uncle Steve, let's be realistic. This is extremely dangerous. At your age, I don't think that you should be anywhere near a rock ledge." But he says, no, I really want to do this. So I say, "Okay, Uncle Steve, but here's the rule. You need to have a rope. We need to make sure you are tied to this mountain because I don't want to see you fall off the mountain." And so if you go rock climbing, let's just pretend Uncle Steve starts climbing up and he's got the rope and he's like, "Hey Ross, I've got my rope." And he's climbing up the mountain. I say, "Hey, looking good." Well, if no one's keeping his rope tight, then he really doesn't have a rope, right? Because if he lets go, then he comes all the way back down. So this is the effect of having, in other words, a stop, right? So if the stock starts going up, 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 maybe you're getting in high, but tighten up that stop. So as you're going up, you're continuing to tighten up the stop, which again, just to work with this analogy, it's about understanding that you're in a high risk position, and you can certainly manage that to the best of your ability by using a tight stop as you trade and not just allowing yourself to go higher and higher and higher without acknowledging the very obvious downside risk. And sometimes it's only, even for me, when in the case of Cat B today, I'm buying it at $7.98 that I suddenly look down and realize, oh my gosh, did this stock really just come from $6? Because look out below. And I'm the guy who bought it up here at the top. I gave back $15,000. Now, I'm okay with the fact that with an entry at $8 that I stopped at about $7.60 or something like that, because another trader might have panicked and let themselves fall all the way back down to here. And now they're in a situation of holding and hoping that it recovers. And you never want to be in that situation. So my opinion always is just to cut the loss quickly. But anytime you're trading any of these sort of high-flying, crazy, volatile stocks, whether it's, I mean, whatever it is, doesn't really matter. You just have to be mindful that you need to acknowledge the risk and set a line in the sand. And some of these stocks can be really frustrating because they'll rip up and then they'll kind of do a false break at the highs. They'll flush way back down. They stop you out. And then 2 seconds later, they're back at the same place you just were in at. And you're like, unbelievable. That's actually exactly what happened to me on costs. So this is a real life example from today. So on costs, I traded this right here as it started to squeeze up. It was right here. And on this chart, let's actually use our 1 minute chart. So it was right here as it broke over the volume weighted average price. So I started buying it at 66 as it broke over the volume weighted average price. And then, you know me, I started going for the big trade and I was adding. I don't remember how high I added. I think I added it. I think my average, I don't remember. I think it was, I'd have to look at my orders, but I want to say because I kept adding, my average was in the 70s. And then right here, it drops all the way back down from a high of 74 to 67. Now, this is actually a perfectly, I mean, yes, it's a big red candle, but given the technicals of the chart, it broke the volume weighted average price. Then it came back and retested the VWAP. So the logical stop would have been about 66. Well, the problem was I had 4,000 shares and my average was about 72 or 73. It came down, it started to break 70. I was down 8,000 and I was like, you know what? Cut it. I hit the bid, I didn't get filled. It goes to 66 or 67. I'm like, oh no. So I hit the bid there. I sell at the sort of rock bottom of this pullback, which was $67. I lost 20,000 bucks like that. And then it rips right back up here. And how do you think I feel? Well, now I feel like a real idiot because I just stopped out on support. Why did that happen? I took too much size. So I took too much size on that trade. And because of that, the dollar amount that I was down during the natural range of the stock was more than I could afford. And I panic sold. It then comes right back up. And I'm like, well, what do I do? Do I seriously get right back in with the same share size at the same place I got out? Because if I do that, then, and it drops again, now I'm going to be really upset. And so this was an instance of not really managing the trade super well because I was too aggressive. I underestimated the downside risk if it went the wrong way. And I just had too much size. And, you know, a break of volume weighted average price, which is a setup we'll talk about in the momentum chapter, this is a good setup, but it's always risky to buy as it's breaking. It's always safer instead to let it break because often they break, then they come back down. And you know, it's true that this could have halted going down at 60. And if I didn't bail at 67, I could have been looking at a $40,000 loss. But, you know, I ended up stopping out right on the volume weighted average price. Then through this consolidation, that became over 75, a clean trade, right? Nice move over 75, hit 85, flat top breakout, break through 85, a squeeze into a halt. It does halt down after that. It bounces, then rips back up to 105. So, and even like this, there might have been someone that bought this into the halt going up right here. So they're long at, like, let's say 94. And then when it's halting going down at 85, they're like, oh, I'm down $10 a share into a halt going down. This could kill me. And then it opens it in the 70s. And then 3 minutes later, it's right back up. So this speaks certainly to the importance of good quality entries. If you have a good entry right down here, you know, you didn't jump, or if you do take the break of the volume weighted average price, recognizing that if you're adding up here, you've already got 5 green candles in a row, it's extended. This isn't, I don't want to get too much into strategy. This is a risk management chapter, but just I think it's worth reinforcing this lesson here, which is that if you wait for good quality patterns and you avoid chasing stocks up at their very high, you will do so much better. So certainly you had a good trade right here. This was a good trade right here. And this would have been a place to be selling and taking profit. Then it halts going down. And then to be honest, this, I'm not really sure that this right here would have been anything that we could have traded. Maybe that's a 1 minute micro pullback right there, but it popped and dropped. Through this area now, I actually don't see a clean setup. But there was one there and there was one there. And I guess this bounce just kind of, I don't know, caught some short sellers off guard. And so maybe the setup would have been long through the high for the short squeeze. But again, if you focus on higher quality setups, you're definitely going to be mitigating your risk in another way there. Okay, so let's go and look now at number 3, the distance from max loss versus profit target. So what does it mean to have a secured climbing rope as a trader? This is essentially getting into a trade and understanding before you enter the trade what your max loss is. And it's not just based on dollar amount. It should be based on the logical place on the chart. Because, you know, again, like I said, if you get in this with 10,000 shares right here and you're saying, well, if I'm down more than 500, I should stop out, that's going to happen so fast, you're going to go way past your max loss. So what you have to do is say, okay, if this is the entry right here at 75, then my max loss should be right down here. That's 71. That's $4 a share, huh? So that is my realistic max loss on this. So I would like to have the potential to make double that. So risking $4, I'd like the potential to make $8 a share. And risking $4 a share, if I don't want to risk more than $2,000 on this stock, I shouldn't take more than 500 shares. So, you know, just jumping into it with 2,000, 3,000 share position, all of a sudden you're risking $8,000 to $12,000 before you know it. And then when you have that high level of risk, that's when you can start to do things that are a little bit emotionally reactive, panicking and selling, and then emotionally jumping back in and then getting out too early or trying to add to make up for the loss. And it puts you off your center. And success in trading, it's not about being right 100% of the time. And more than anything, it's about learning to cut your losses when you're wrong. And since whenever we take a trade, we should expect that it has a high likelihood of being a loss. I mean, maybe 50% for a beginner, and even for me, still 30% chance of being a loser. I don't want to take a trade where if it does go the wrong way on me, where we're talking about something that's catastrophic. So capping our losses requires, I mean, from a risk management perspective, it's about knowing your max loss, and that understanding your max loss means understanding the chart pattern that you're working with. So if you imagine right now, what if you could cap every loss you'd ever taken, or sorry, imagine if all your losses were $10 and all your winners were $90. In that scenario, you wouldn't need to be right that often to cover your losses. In fact, if you were right even just 10% of the time, you would be break even due to the 10-to-1 profit-loss ratio or 9-to-1 profit-loss ratio. So trading is kind of like skiing. When you go skiing, you know that there's a good chance that you're going to fall. Falling is kind of inevitable. If you went skiing with someone who was afraid of falling and said, no, I don't want to, I'm afraid of falling, naturally they're not going to push themselves. They're going to be very timid. They're going to try to go on a slope where the risk of them falling is almost like non-existent. And to be honest, that fear is going to hold them back. And in trading, it's not different. We should expect, just like skiing, that you might fall, that with trading, you will fall. And in fact, learning to fall skiing in a controlled way is important. So, you know, if you start to feel like you're getting out of control, you know, that's when, you know, you don't want to start, you know, you don't aim for a tree as like, oh, I'm gonna aim for that tree because that'll stop me real quick. It's gonna stop you a little too fast. You know, when you start to get out of control, usually as a skier, you start to feel like you're going too fast, and you know, you can kind of throw your body down against the mountain. You don't just keep going straight, going faster and faster and faster and faster. And trading, you know, it's similar in the sense that loss is part of trading. And when you have a loss that's going the wrong way, you don't want to just hold it and let it get bigger and bigger and bigger and bigger, right? You want to cut it and just stop that loss right there. So it's just important to cap your losses. And if you can cap all your losers, then ultimately you're capping your downside risk as a trader. So you have to always know what you stand to lose. If you don't understand what you stand to lose, then you've immediately come into the market focusing on profit, not on risk. So again, it's one of these mentalities of, are you thinking about the risk of trading, or are you just thinking about the potential profit? Because if you're thinking about profit, that's where you're getting into gambling more than trading. So you got to know your potential risk, and you need to know how to establish whether or not the trade really carries enough value and potentially even take it. I'll say that in markets like this, I do find myself, I find myself questioning trading in a choppy market, because when the market's really hot and I'm able to make $30,000, $40,000, $50,000, $100,000 in one day, and I've had more $100,000 days in the last year than I can count, what's even really the point of trading on a day when nothing is really moving that much? And, there may be something to be said for really easing off the risk so much on those days, but I somehow, every single day I come in, I find something to trade every single day. And I do sometimes look back and think, man, you were just grasping at straws. Why were you fighting so hard for that, $5,000 when the market's hot, it comes just so much easier. So being able to be honest with yourself also about the current strength of the market is important, because sometimes we get in this mentality of, well, today is the last day of the month. This was the last week of the month. And right here in the last week of the month, I went from being red on the month to green. And yes, that was very, very convenient because I don't like to have red months, but the market doesn't care that it's the end of the month. So if things had been really slow this week, if I had been really trying to push to finish the month green, well, I'm not trading the market I'm in. At that point, I'm just trading my own P&L on the month. And that's where I'm going to start to get myself into trouble. So through this course, we'll be talking about profit-loss ratios a lot, and we've already done a pretty good explanation of it, but let's do a little refresher for those that in the pro course or in the starter course maybe brush through this section. So if your average winner is $2 and your average loser is $1, you would have a 2-to-1 profit-to-loss ratio. So over here in my metrics, when I'm looking at my metrics, I can always see very easily what my profit-to-loss ratio is. Well, I see it based on the dollar. So I have $3,300 average winners and about $3,100 average losers, which does give me a positive profit-loss ratio. Things have really turned around this week in my profit-loss ratio. My accuracy is still a little low at 61%, but the profit-loss ratio has improved. So I would say successful traders should almost always strive for a minimum of 1-to-1. We really don't want to see you in a situation where your average losers are bigger than your winners, because when your average losers are bigger than your winners, you lose confidence. It doesn't feel good to have 3 small winners and then 1 loser takes them all out. So unfortunately, the downside with having a lower profit-loss ratio, maybe as low as 1-to-1, like what I have, is that your accuracy is going to need to be a little bit higher to carry you high enough to be profitable. Again, here's the thing that I think is okay. I think it's a lot easier to predict what a stock is going to do over the next 15 or 20 minutes using technical analysis, like looking at a chart. Now, I can look at this chart right here on costs, and I can say, even right now with pretty reasonable certainty, that I think this has a higher likelihood of coming back down to 78 in the next 20 minutes than actually getting back through the high of day. That's due to the topping tail candle at the very top. Again, I could be wrong, but it's going to be much easier to predict what it's going to do in the next 15 minutes than to say what I think it's going to do over the next 3 days. So as a day trader, when we're working with very small periods of time, it's much easier to have these predictions and say, listen, all right, at this point, I think this has a higher likelihood of going to 400 than going to 330, given what it's doing right now. So based on that, I'm going to focus on the trade to the long side, and I'm going to manage my risk accordingly. So I think that you can have a much higher likelihood of high accuracy day trading than you could possibly achieve if you were focusing just on swing trading or maybe long-term investing. However, it's true that if you do have a really good profit-loss ratio, you could afford lower accuracy and still make money, but I think it would cause an issue with confidence. So just to kind of circle back to the important sort of line, I don't know, whatever you want to call them, benchmarks here. If you have a 2-to-1 profit-loss ratio, your break-even point is 33%. Okay, if you have a 1-to-1 profit-loss ratio, your break-even is 50%. If you have a 1-to-2 profit-loss ratio, your break-even is 66%. Now that's going to be really hard. So over the course of my years of trading and reviewing trades of tens of thousands of trades of various students, yes, that's true. But over the course of my years of trading and after reviewing tens of thousands of my own trades, while I've always aimed for the 2-to-1 profit-loss ratio, I typically see 1-to-1 as being more common for me. I aim high, but I come in slightly low because I take profit off the table. So the result is the profit loss ratio comes down, but the accuracy goes up. Now, what's true is that through working with students over these years, I have found that that pattern is not exclusive to me. Most people will find that if they start swinging for home runs, accuracy declines. And yes, the occasional home run will give you, obviously a nice trade. I mean, it increases your average winners. There's no doubt about it. But for all the trades that were a nice base hit that you didn't take off the table that then turn into a loser, those bring your accuracy down. So they do have this inverse relationship, your accuracy and your profit loss ratio. And just to reiterate, my focus generally is going to be to focus on accuracy because of the benefit of being, of the confidence that comes with that. So putting statistics in your favor, first of all, means knowing what your stats are, knowing your average winners and losers, always aiming to improve that ratio, and recognizing that even small adjustments over the course of months and years can make a huge difference. So, if I know that I can make my losses just a few cents smaller, just for instance, if I'm trading 10,000 shares a day, 1 cent's $100. So if I made all of my losses 1 cent smaller, that would save me $500 a week. That could save me, $2,000 a month. What if you could make them 10 cents smaller? What if you looked at some of the biggest losses you've ever had and then said, well, where should I really have cut that loss? Because if you could tighten up those extreme ones, that's going to reduce your average loss across the board. So part of being successful is going back and looking at your metrics of where you've made mistakes and then making an effort to try to turn that around. So this is the target profit loss ratio and the profit loss ratio table, and the target being generally 1-to-1 minimum, but knowing that anything in this area is green. So if you have a 2-to-1 profit loss ratio, you could be right 20% of the time or 30% of the time right here at this line and be profitable. If you're 4-to-1, 5-to-1, you could be right even as little as 20% of the time and still make money. The lower your profit loss ratio is, the higher your accuracy has to be to break even. And so finding that middle ground where your average winners and losers are about the same size, that means if you're right 50% of the time, you break even. I think it's a good starting point. And then I think obviously from there, you want to strive to improve that accuracy as much as possible. And the good news is that generally accuracy improves with practice. The more you practice, the more experience you gain, inevitably accuracy improves. As long as through your practice you are exercising, focusing on one strategy and not just being haphazard. If while you're trading, you're just haphazardly doing a little of everything, then you may not see improvement. But if you're really focused on trading this one strategy and trading using the charts and the technical analysis, and you're using the same tools every single day, then through that experience and practice, your accuracy should improve. So it wouldn't surprise me if right now at a starting point, some of you are trading at only 30% accuracy. Ludwig just said it took him 3 months, but he's at 66% accuracy right now. So for the first 3 months, most likely his accuracy was lower, but through practice and practice and practice, he began to make better decisions. I mean, just again, think about it. You take a losing trade at a certain spot enough times, marketing into this, up here at the very top, you realize that, maybe I should start waiting for the pullback. Maybe I should start waiting for the better setup, the first candle to make a new high, et cetera, et cetera. And then as you start to learn those lessons, which come through experience, you start to get better. So I would say that 2-to-1 is sort of the golden ratio to strive for. While it's where I set my goal, it's not always where I come in. I wouldn't want to take a trade. If I took a trade and I was like, I'm risking 10 cents to make only 10 cents, that just doesn't feel worth it to me. I always want to feel like I'm getting in with less risk than profit potential. 2-to-1 is a good ratio, but it can be hard to really dial that into the penny, and it's not necessary. I think while I'm trading, I can usually say, all right, I think that I can probably have a relatively tight stop on this stock, and because it's so volatile, because it's moving so quickly, the first 1 minute candle to make a new high, I think it's reasonable to expect, a 25, 30 cent, 40 cent move out of this breakout. One of the reasons I don't like trading stocks on the cheaper side, below $1.50 generally, is because usually even getting as little as 10 to 15 cents of profit is hard because that's 10 to 15%. And it's hard to keep stops as tight as 5 to 7 cents oftentimes. I mean, again, if we have a stock where the level 2 is very thick, like Siri, it would be easy, but we're never day trading those. When we're day trading stocks, what was the one today? TXM, there was a stock today, it was a cheap one. TZX, I can't remember, but anyways, TRX, thanks. So TRX, this one is back at 94 cents. But this one did start to make a little bit of a move today. And I was just like, guys, I'm not interested in this. I recognize that that's nice from 90 cents to $1.90. But by the time I saw it, it was already halted at $1, I think 30. Initially, of course, below $1, it wouldn't have been on my scans. I wouldn't have been looking at it. It finally halts at $1.30, and I'm like, all right, so what am I going to do? Get in at $1.40 on the resumption. It halts immediately at $1.50. Then it goes up to $1.74. In this case, yeah, you could have gotten 20, 30 cents, but for me to make decent money on something like this at this price range, I would need to be taking 30 or 40 or 50,000 shares. And I'm not going to buy a stock after the second or third halt going up with that kind of size. It just doesn't make sense from a risk reward perspective. So yeah, generally when we think about cheaper stocks, I'm just usually like, I don't know. And recently, in fact, if I look at the biggest winners I've ever had at this point, I'm going to say that they were probably all, interestingly enough, on higher priced stocks. That's a little bit different this year from last year, or from maybe previous years. Last year was probably the same, but yeah, I'm looking at my biggest winners right now. My top 10 biggest winners at the time I was trading them, they were all over $10 a share. So the thing with those stocks is that when they start to move quickly, they can really, really open up. And that's what we've learned, and much more so than these cheaper stocks. But still, even with a higher price stock, we do still have to do the same analysis of, okay, risk and reward. Okay, so maybe let's say right now it's starting to base out a little bit in this channel. So it might make sense to say, all right, downside risk on this is about $87. Well, volume weighted average price is 79, so it could flush back down. But if it can break through the high of this area here, which it shows it struggled with, 93, then we'd look at a move to 96. Then we'd look at a move here up over 99 and 100, and then maybe back to 107. So, the longer it bases out, we might start to feel like, okay, maybe there's an opportunity for a trade here with a tight stop, like kind of right, around this price. And I think in that case, with an early enough entry, that could give you, with a stop right there, potential maybe up back to 100. And if it broke 100 up to 102 and 3, that it definitely would give you the 2-to-1 profit loss ratio. But 2-to-1 profit loss ratio by itself is not enough. We have to have enough conviction in the strategy, in the specific setup that we're trading. And at this time of day, on a Friday, I would not have the confidence and conviction to take this trade with real money. But so it's layering all of these things together that ultimately will be what helps you make the decision of, do I take this trade or do I not take it? So this was an example that I've shown a couple times where this was a stock at $10.25. It had squeezed up a few nice green candles in a row, as you can see here. And the entry for the first 5-minute candle to make a new high on this 5-minute bull flag was $10.25. Now, regardless of what the level 2 looked like and what the float looked like, we can see that this stock has already moved from, probably at least $9.50 to over 10 to $10.50. So it's moved $1 a share, over 10% in a pretty short period of time. That's showing us it's got the potential to move. Here's the pullback. First candle to make a new high, that's $10.25. Now, the low of the pullback is around $9.90. Generally, I would say on something like this, I would set my stop probably at like $10.05, because if I wait for $10 to break, it's psychological support. And when that breaks, you can see that flush. So usually we're going to talk about wanting to stop out just before those critical levels break. And of course, that can be very annoying. If you stop out just above it, the critical level holds, and then it bounces right off that. And that's one of the reasons we're going to try to focus more on breakout or bailout, so we're not even holding in a situation where we're right next to the max loss. But in any case, so here our max loss is about 20 cents a share. So we're risking 20 cents a share, entering at $10.25. A reasonable profit target on this would probably be first that we see a test of the $0.50, $10.50. And if we break $10.50, then we're looking at $10.65, $10.70, 1075, 1080, then up to 11, knowing that we kind of trade around $half and whole dollars. So in here between the half and whole dollar, stop just above 10, target first is 1050. When we hit 1065, that's the full 2-to-1 profit loss ratio. So at that point, there's a high likelihood that I would be taking some off the table. It's also possible on a trade like this that if I got in at 1025 and it was looking really strong, that I would add at 1048 for the breakthrough, that psychological resistance. And as soon as it broke through that level, I would take a little off the table in the 60s. Now my average has moved up from 1025, maybe to 1035. So now my stop is break even on the rest. And if it keeps going to 1085, 1095, I could take a little more off the table, a little more profit. And then maybe if it pulls back just for a moment under 11, which it kind of looks like it did, I could even add back for the break of 11. And now my new stop, whatever my cost basis is at that point, maybe it's moved up because I added to 1075. Stop is break even. Now looking for the breakthrough 11. There's 1125, 1135, 1145. So that would be one way to trade this, where you're getting in, adding, selling, adding back, selling, and continuing to adjust the stops as you're moving higher. These are always, of course, mental stops, not live orders with live stop orders. And then the other way for someone who perhaps doesn't want to aggressively trade in and out of the stock would be to say, I'm in at 1025, my stop is 1005, and I'm going to try to just hold this, take a little off the table when I hit my first profit target, take a little bit more as it goes higher, but just try to kind of let it work. And then that same person might be coming back in for the next 5-minute setup right in this area here for the move up to 12. So when we talk about getting in and getting out, I see a question there about would I be getting in at the bid or the ask? So we're going to clarify that when we get more into strategy. I can tell you that when I'm buying, I am always buying at the ask price. So if we put up ZVZZT, NASDAQ test stock, if I want to buy this right now and I put the order at 99, so I'll move this up here. I'll move this back down here. All right, so if I put the order on this at 99 to buy, you know what's going to happen? My order is just going to sit there and wait. That's the open order. It's just sitting and waiting. So I'm not going to buy this on the bid. I won't get filled. When I want to buy it, I want to get in right now. I've heard of some people, I remember someone who was like in one of those old chat rooms, and when I was first getting started, there was so many chat rooms out there. And anyways, he was making money, and a lot of people were kind of like, dude, how are you making money on this stuff? And he's like, oh, I'm always getting in on the bid. That must be the difference. And it's like, I don't know about that, because to buy on the bid means you're only buying when someone is selling to you. That just doesn't add up. When we buy momentum stocks, we buy at the ask price. Boom, I'm in like that, right? I'm in at 1001. Now, if I want to get out, I can try to sell at the ask price to get the best price, or I can just hit the bid. And so when we were talking about hotkeys in the starter, I was talking about how it's probably a good idea as you're just getting started to use one hotkey for buying and one for selling. Buy at the ask, sell at the bid, which essentially is a market order. But it simplifies things, and it makes it so you're not going to be in a position where you have orders that are not filling and things like that. When you get further into this class, we'll talk about some of the strategies for selling on the ask and the hotkeys that we use for doing that, the offsets and things like that. So, it's kind of funny, but part of being a good trader is being a good loser, being good at losing. I'm wrong 30% of the time, and I still make money. So, being good at being wrong is important. That means taking small losses, being willing to not being afraid of them, just letting the loss happen. And one of the things you'll find is that if you, for instance, traded and every time you took a trade, you set a custom stop order. Let's see. Where's a 15-cent stop, for instance. If every time you took a trade, you jumped in and set a stop right away. So I'm going to jump in this and I'm going to set a stop right away. You would find that, sometimes, boom, you get taken right out. Certainly on a stock like GME, a 15-cent stop would not be adequate because your stop would be between the spread. But, again, depending on the stock. But what you would also find is that your best trades, they work immediately. Your best trades will almost always work immediately because you had the right timing. And so given that your best trades will work instantly, if you get in something and it does start to hesitate and it's not really working, you pretty much can guarantee already that it's not going to be your best trade. So at that point, it may make sense just to cut the loss even at break even and not keep waiting for it. So that's that breakout or bailout mentality. So sometimes I'll sell for a small loss and then I end up seeing the stock run, and sometimes I'll get right back in, but I don't really mind that too much. Breakout or bailout. And when you watch the live trading archives, you'll see so many examples of me just bailing out really quickly, being like, nope, don't like it. And then 15 seconds later, I'm back in. I saw something at that moment that I didn't like, so I hit the bid. It was the right move to make, I think, at that time. But it ended up continuing higher, and so then I was willing to jump back in. So if you look at a stock like this, for instance, breakout or bailout, here's my winning trades here, like $2,300 each, $2,600. My two losers are break-even trades, essentially. I just hit the bid, I was out. And I just said, you know what, I'm out. I'm not liking this. And I think that that's the better approach. Trying to hold a stock because you refuse to take the loss on it because of the monetary issue or because of the feeling that you get when you lose, it's just, to me, not worth it. It makes a lot more sense just to be kind of trade at a level where you can just cut the losses, where you're not having a big emotional response to being in the red. And if that means, using that piece of tape, to cover your P&L and just hide it, then, do that. If it means trading with smaller size, then trade with smaller size. You can use whichever coping mechanism helps you get through that. But being ruthless about just cutting those losses fast is going to be pretty important. Now, right now we're talking primarily about setting hard stops. So that means if we see our max loss, we bail out of the trade, we hit the bid. We haven't talked a lot yet about determining the profit target beyond just saying it should be 2-to-1 or something like that. For right now, that's okay. When we get into strategies, we're going to be talking more for each individual strategy about my feeling of what the profit target is. What is a realistic profit target? Some strategies and some setups, my profit targets are going to be much higher, and for others, they're much lower. And so you may prefer different setups to others, as probably anyone would. And so having a realistic sense of, given that setup, what the profit target is will be important. But that's one of those things that we're going to fill in the blanks on that as we keep going. So as we begin to look at charts, support and resistance levels, you'll learn more about how to understand realistic profit targets. When people say, I'm buying GME and I'm holding it to $420 because, they're on Reddit and they say they love smoking pot and 420 is a cool number, that's not the type of profit target that is based on any type of technical analysis. So we're going to use profit targets that are logical, that have actual purpose. Perhaps they do line up with a cool number like 420, but most of the time they don't. Most of the time it just will happen to be 430. That's the pre-market high, that's the level that we're looking at. So again, helping you visualize that, it'll start to become second nature for you. So now we're going to talk a little bit more about stock halts. We did cover this in, I believe it was chapter 11 of the Warrior Starter course. I had wanted to do that because starter students, some who were while they were in the starter class and were practicing trading before they got into the pro classes, were confused about halts. So I did want to cover it at least in some detail. So as you already know, stocks can be halted and paused from trading for several reasons. And during a halt, you cannot buy and you cannot sell, and you are stuck. And they can last for minutes, or they can last for hours or even days, depending on the type of halt that we're looking at. So these are our halt types. We have T1, T12, and limit up, limit down. Those are the halts that we see really on a very regular basis at this point. Well, I guess maybe not so much T12. T12, you might only see that, I don't know, every now and then. We can pull up the website for NASDAQ trader halts. So this is the website here that I use for NASDAQ halts, and it's going to show any stock that's actually halted. I'm almost positive it's not just NASDAQ. And then the New York Stock Exchange, NYSE, has their own right here. So these are stocks, UUU, for instance, that was halted today on an LULD, which is limit up, limit down, circuit breaker halt. Where's the chart on that one? So UUU, which I didn't end up trading, I kind of missed this move. But anyways, it went from $8 to almost $20 a share, which is crazy. Although, just as a side note, I saw a student who said, man, I just blew up my account, my small account on this. And it was when it was halted going down right here. And I was like, man, well, number one, I'm glad it was a small account and not, a $50,000 account. But the only way you blew up an account is if you bought it like way, way up here. After the first, second, third, fourth, going into the fifth halt, going up for your first trade? Come on. let's try to tighten that risk up a little bit. Now we all make mistakes, and with a small account, those mistakes can be pretty painful. But yeah, this is a high risk example. Anyway, so just don't think that it can't happen to you, because it could. So they're showing halts on NASDAQ exchange and NYSE exchange, and I think the NASDAQ is probably doing the same. Yeah. So anyways, it shows all the stocks that are halted. So we've got lots of LULD volatility halts. M is for Amex and NYSE. It's the same. It's a market volatility halt. NASDAQ calls it M, but then even NYSE, they call it LULD pause for themselves. So I don't know what that's about. But do we have any T1s? T12. We've got one T12 right here. So the T12 today is on SVA. So let's look at that one. So this one is halted. It's been halted since 2019. Wow. It's been halted since February 22nd, 2019. So every day it shows up on the halt scan. I don't know. Let's see let me just see what some info on the stock is. It's founded in 1993, based out of Beijing, China. They do work on hepatitis, seasonal flu, pandemic influenza, H1N1. So research, development, manufacturing of vaccines. It's a very topical sector they're in. 29 million share float, but yeah, it's been halted for a long time here. So I don't know what the reason is, but anyways, for whatever reason, it's halted. Now, that's the only stock in the entire market currently that's still halted on a T12. You can rest assured that on the day it was halted, we wouldn't have been trading it. You can look at this price action, and there was nothing we would have been trading there. It wasn't even moving. It had 8,000 shares of volume. So it's not, for whatever reason, maybe the company had some issue and the exchange is looking into it, and maybe they're getting delisted, and I don't know. But anyway, so let's get into these different halt codes. So T1 is when the company is halted pending news. So a company can request the exchange pause trading in their security so they can release material news. T1 means it's halted, and then it changes to T2 when the news has been released, and then it changes to T3 when the news has been fully released and they are getting ready to resume trading in the security. T12 is a halt by either the listing exchange or a regulatory body, and that's when they're suspending trading in the stock, usually pending either the company providing them some type of information or something like that. Now, I see a question in chat. How do you get out of a stock if you did own that stock in 2019? Unfortunately, the reality is you wouldn't be able to get your money out until it resumes trading, either on this exchange or on a different exchange, maybe the OTC exchange. And so your shares would move to that OTC exchange. You know, it's reasonable to be concerned about that risk. However, I will tell you that this is pretty uncommon and is not something that, I mean, again, knock on wood, I have not been caught in a T12. I feel like I have to knock on like a lot of wood. It makes me nervous saying that, but it hasn't happened to me in 10 years of trading. So I think there are certain instances that you would be exposing yourself to that higher level of risk. And, you know, this could be one of those things where if you bought this and you were a bag holder and you were just holding it and hoping it would go back up, well, and then something like this happens, that would be bad. And that's maybe another reason why it's always important just to cut the losses and move on to the next trade. Now, a T12 halt typically will only last maybe a day or a couple of days. So the fact that this has lasted this long also speaks to something specific going on with that company, most likely. Usually a T12 halt will just be a few days, and it's not super fun to have that happen, especially if you're holding the stock, but it's usually a short period of time, and then it resumes and you can move forward. All right, so that's a T12, and yeah, I'm not sure if there's anything else on that. So, well, okay, so I can't remember. I think I have a couple examples. So let's keep going and then we'll come back to that. And then LULD is what we traditionally call circuit breaker halt. A circuit breaker halt is a volatility trading pause, and stocks under 3 have different rules and thresholds for those circuit breaker halts than stocks that are above that price. When the stock is halted, you cannot buy and you cannot sell. Now, just this last year, we began noticing an interesting pattern. Recently, New York Stock Exchange, the listing exchange that manages NYSE and Amex stocks, has halted stocks trading up significantly, 100% or more, with no news. They request the company comment on the move. So they halt the stock pending news. They ask the company to release news, and then the company usually releases news and says that there's no news to account for the move. Not for the news. Let me just fix that typo. There's no new news to account for the move. And when that's the case, usually the stock drops 50% or more. Now, because this trend has been isolated to to stocks listed on the New York Stock Exchange, it's important, therefore, that when you're trading either in the Sterling simulator or you're trading in Lightspeed or whatever it is, to check to see what the listing exchange is for the stock. So I can see that this is NASDAQ. GME is actually a NYSE stock. So ironically, GME has not gotten halted. Even though it has gone from $10 to $500 a share, it has not gotten halted by the exchange. And in fact, just yesterday, we saw GBR go up 900% from a low of $2 to a high of 30, and it also did not get halted by the exchange. So to be honest, I don't know who's making the decision over there of why some get halted and some don't. However, I think it's worth acknowledging just that risk factor with certain stocks that are listed on a NYSE or Amex exchange. So the typical circuit breaker halt or volatility trading pause for a tier 1 security priced above $3, which I believe would be a security that's part of the Dow Jones Industrial Average and also possibly a security that's in the S&P 500, but I'm not 100% sure. If they go up or down more than 5% in a period of less than 5 minutes, they will get halted for 5 minutes. Tier 2 securities priced above $3, the volatility band is a little bigger to accommodate for those stocks being a little more volatile. Usually those are small cap stocks. And then tier 1 and 2 securities priced between 75 cents and $3, the volatility bands are even bigger at 20%. And for tier 1 and 2 securities priced below 75 cents, the volatility bands are 75 cents or 15 cents or 75%, the lesser of whichever one is occurring. Okay, now at the close, the volatility bands are actually doubled during those times to accommodate higher levels of volatility. And that also used to be the case at the open, and then that stopped, and they changed the rules, so I don't know why. So this is a stock that's halted on a circuit breaker. What time will it resume? Can anyone tell me? So the halt time here on our time in sales is 9:42 and 1 second, which means resumption will be 9:47 and 1 second, approximately. It could be, it could be a few seconds off, but it's usually pretty close. So in this case, something that's also interesting is that when a stock is halted on the American Stock Exchange and NYSE Stock Exchange, you cannot see any pricing information. Whereas on the NASDAQ Stock Exchange, they will show you the current quote. So while the stock is halted, even though you know that you can't sell the stock, what you could do, and is there a stock halted right now? Well, we've already done this in the starter class, so you already know. But if a stock was halted right now, if this was halted, I could actually, and this depends on which broker you use, but depending on which broker you use, some brokers will let you place an order while the stock is halted. So when GME was halted, for instance, people would place orders to buy and to sell, and they were confused. They were like, what's happening? Well, some of those brokers were accepting their orders, and they were basically just putting them in queue. So when the stock resumed trading, they would go through. So what NASDAQ is showing us is basically the current quote based on all the orders out there that are, quote, in queue. So this shows us the current estimated resumption price. Now, in the case of stocks, and we could look at costs as an example of this. So this is coming back down a little bit, but let's look at this yesterday. So yesterday, this halted going down here. And when it halted going down right here, this was, I don't know, this was pretty dramatic, to be honest, but it broke 70. It halted going down, and then it resumed at $44. And it actually immediately halted going up. And you know what that tells me? Most likely you had someone who shorted really, really big size, probably in this sell-off, And then during the halt, there were people that were marketing out, panicking out. So there were lots of sell orders. Then on the resumption, because all those sell orders went through, it opened at a lower price because more sell orders than buy orders. And then the only buy orders that went through were people covering their short position for profit. Excuse me. So anyways, this is kind of a wild example. But during the halt, you would have been able to see approximately the price. And what sometimes happens is when you see that something's about to halt going down, it's halted down, and you see that it's going to be opening a lot lower, some people will start putting out orders to buy the dip. And I'll do that sometimes. I'll be like, okay, well, hey, if it's going to halt down and gap down 10 points, I'm going to try to buy that dip. Other people will just be putting out sell orders to panic because they're like, oh, this is going to be so brutal. I just want to get out of it, and I don't want to look at my computer for the rest of the day. And we've all been there. So the result is that while the stock is halted, the quote price may fluctuate, and usually it's going to be close to what the open price will be. But sometimes it also surprises us in the case of costs actually today, where it halted going up right here. It then opened at 94 and then just immediately dropped $10 a share. So that didn't gap. It opened at 94 and then just tanked. And I don't know why that happened. But anyways, that sometimes happens. So on Black Monday, this was August 24th, 2015, Black Monday round 2, there were over 1,200 circuit breaker halts when the market opened. It was one of the most extreme amounts of volatility that I'd ever seen in the market. And then in March of 2020, the market dropped 3,000 points in one day, and it was the largest single point drop I'd ever seen in the market. And stocks left and right were halting going down, even big stocks, and then halting coming back up because they were just trading in such huge ranges. So while there are many aspects of a circuit breaker halt, a volatility trading pause, that we actually really like, there are also instances where they can be very challenging and can put us in a position of taking a lot more risk than we may intend because of the open. Black Monday, the original Black Monday, I believe is, it's a reference to the Great Depression. I'll just check the actual date. It was Black Monday stock market. So there's a couple. So we had it was a Black Monday in 1987 when there was a market crash. So Black Monday round 2 was, I guess, this August 24th. But I don't know if anyone really talks a lot about that. But anyways, so number 5. So we know that halts, and just to recap, we know that halts obviously carry risk, but we can also sort of leverage the volatility that is occurring while stocks are halting or around halt levels to generate some really good profits. So halts are not bad, but they're something to be aware of. And obviously for us, those of us trading with Lightspeed or Sterling, we have the very fortunate benefit of being able to highlight the halt levels. So I can go right in here, and anyone that's on Lightspeed can do the same. We can go to the market maker boxes, quotes, and then over to highlights. And then we go to, we type in LULD, and then we make it whatever color you want. And then you do for, let's see, for all stocks, all stocks, and then you do it like this, LULD, and then you add it right here. So it would be what it is right there. And then from that point forward, you can see that the volatility bands, which are always moving based on that rolling 5-minute period, are currently at 370.30 and 302.98. So this is especially helpful when I see a stock dropping because I don't want to be in a halt going down, almost ever. So if I will occasionally do a dip trade on a halt going down, expecting a gap higher, but that's a very specific setup that I'm not going to get into right now. But in any case, I usually wouldn't want to be holding into a halt going down. So if I was trading with a different broker, maybe like E-Trade or TD Ameritrade, I might not have the benefit of seeing those levels. On Sterling, you can also see them right here, LULD, LULD. Okay. So now, number 5, allowing fear to prevent you from following your trading plan. This is very important. If you intended to take a quick breakout trade, you don't want to turn it into a 5-hour hold, and you certainly don't want to turn a day trade into a swing trade. You generally don't want to average down if that wasn't part of your plan. Now, if part of your plan was to take a starter while something was selling off and to maybe add more on a dip, that's fine. But that would have had to have been part of your plan, and in order for you to be trading that certainly with real money, you would have needed some established track record to help you justify why that would have been a good decision. And we don't want to add to a bad chart pattern. So just as a real-time example here, I saw in the small cap room, someone said, oh, Cat B got me again. So something like this, that's a nasty drop there. I wouldn't want to add to this. Now, yes, you could say, well, it kind of looks like it's going to bounce off that 200 moving average on the 1 minute chart. Yes, it kind of looks that way, but it's below the volume weighted average price. And at this point, if I was a short seller, I would be looking for this to bounce up to add more shares short, and my stop would be above 69, the volume weighted average price. So at this point, this isn't really something you want to keep adding to. I think it would make a lot more sense to cut the losses. And as an example for me yesterday, when I was trading GME, I was using every penny of buying power that I had. I mean, seriously, I was using every single penny of buying power. So at one point, I was in a trade on GME and it wasn't looking good. And I was seeing another stock that was starting to open up. And I was like, oh, you know what? So I was kind of like, at first I was like, oh, I'd like to take that one. And I was like, well, but I'm in GME and I can't take them both at the same time. And so I looked at GME, I said, you know what, is this one worth holding on to right now? And I was like, it doesn't look good. I'm just going to sell it, free up that buying power, focus on something else. And so, this is kind of speaking to the opportunity cost that comes from focusing on losers. Whether it's trying to manage a loser by doubling down or holding it for weeks and months, it takes your focus. And that focus is then, of course, being taken away from perhaps better opportunities somewhere else. So even today, this morning, I was down 84,000 on GME. And while it might have been nice to make back all of that and be green on GME, I said, I'm down 84,000 on GME. I don't see any setup on it at that point, at that time of the day that I liked. I think my better bet is to focus on something else completely. And my P&L may end up just being, green on these stocks and red set 84,000 on GME. And maybe I don't get back to green today, but to get fixated on trying to recover the losses from that specific stock is, I just don't think it's usually worth it. So be the best trader that you can be. And this means trying not to worry too much about how much other people are making. And that includes me. I'm at a level that's very different from most people out there. I could say the same thing though. I'll see on Twitter or, I'll see on Reddit, or I'll see someone somewhere post that they made $1 million, on GME or $5 million. And I'm like, I have a big enough account. I could have bought that many shares, but I didn't. And so, there's a part of me that could feel a little FOMO. Just like you might feel FOMO when I'm having a big day, I could feel FOMO when I hear someone else out there is having a big day. There's people out there last year that probably made 15, 20, $30 million trading. And I made 5. So there's always someone down the line. For the person who made 15 and 20, there's someone out there that made 100 million. For the person that made 100 million, there's someone out there that made 300 million. There's always someone down the line that will make more money than you unless you're the richest person in the world. So if you are constantly comparing yourself to other people, I will say that sometimes comparing myself to other people can become a positive motivator because I see how well some people are doing and it makes me want to do better. And I'm thinking, okay, I can do better. Let me try to step it up. So there's something to be said for healthy competition. It's if you go exercising with a friend, you kind of push each other and you both get something more out of it than either of you had if you'd gone alone. So that is the benefit definitely of being in a community of people that are giving you that kind of healthy nudge and encouraging you to try to be your best and do your best. But it can also very quickly turn into, a pity party if you're looking at someone who's just crushing it and it's making you feel bad about yourself. So that's another moment where it's an opportunity for you to be honest and say, I don't think this is healthy for me to go check the P&L of every other day trader out there every single day so I can just see how much more other people made and feel bad about myself. That's not healthy. That's not helpful. So if you see someone on Twitter or hear of a trader who just had a huge winner, keep it in perspective. If I see a 17-year-old who made $10 million on GME, I'm probably going to think, well, you know what? I mean, first of all, good for him. That's awesome. Also, he probably is in a position financially where he could afford to take a little bit more of a lottery ticket. I am an adult. I have a family. I have a house. I have to be responsible. We're in very different places. And that is a very, very significant difference between a 17-year-old and where I'm at today. But you could say that about anyone, and so instead, coming back to your focus of my job each day is to try to get 10 cents out of the market. And if I can get 10 cents a day and I can do that for 3 months, then maybe I start trying to get 20 cents. And if I can do that consistently, maybe I start trying to step up a little bit. And at that point, I'll have the experience to know when it's time to step up. But you've got to set your sights based on what makes sense for you. And you're not stronger than the market. So you've got to just accept defeat with humility. Some of the traders out there, like the big hedge fund owners, some of those guys, they can just keep buying and buying and buying. They can buy so many shares and then they can petition the board to do this and that, send a letter to the CEO. They may actually be able to, kind of muscle the stock into a winner if they take a big enough position and they have enough influence with the company. You're not going to be able to do that. So take your losses, and move on to the next trade. So avoiding that impulse to double down. Add to winners, not to losers. Now, there are times in the case of my trade on costs where I added too aggressively. I kind of just was seeing the potential and I was like, wow, this thing is awesome. It's breaking VWAP. It's going to rip right back to 100. I had done really well on it yesterday. And so I was just like, all right. I was looking at this move up here, back to 79.80 or whatever. And so on that one, I was definitely too aggressive with adding into the winner. But I think it's generally a better practice to be adding to winning positions as the stocks continue to trend up, where you're continuing to trade with the momentum, and to avoid adding to losing positions. While it is an advanced strategy to do a dip trade or to add on a flush to bring your cost basis down, that's not a strategy that almost any beginner trader is going to be able to execute correctly. So if a trade isn't working, I can always sell half also. With that breakout or bailout mentality, if I take 10,000 shares and I don't get the immediate breakout, sometimes I'll just say, you know what? Let's just unwind half of this trade. Let's just cut half of it off the table because the best trades work immediately. This one's obviously already not working, so it's probably not appropriate for 10,000 share position. Let's cut half off the table. Now, if it keeps going, maybe I can get back in, but right now, it's given me a little bit of a red flag. So I try to avoid averaging down. I will do it occasionally. To be honest, out of all the times I've done it, I don't know if I'm net positive from doing it, but I am at a place in my trading where there are times where I would not do the same thing I would, say a beginner should do. And I think you have to acknowledge that when I'm trading my account. I'm not saying I'm only going to trade beginner strategies. I'm only going to follow the rules that I would give to a beginner because that's not the place that I'm in. So I will try to be more aggressive. I will sometimes take higher risk and average down. I try to avoid it, but occasionally it'll happen. Now, revenge trading and snowball days for me were like my Achilles heel, and I still sometimes fall into this habit of revenge trading after a big loss. I try to double down and make it back, and I just get way too aggressive, and it makes the losses worse. So this second cause of failure, or third cause, or whatever we'd like to say, is concerning for me. Revenge trading and snowball days. When a trader goes in the red and instead of calmly walking away, starts emotionally, impulsively trading the market, buying anything that's moving, and perhaps even worse, doing this. Let me show you what this looks like. Let's see. All right, so let's say costs is going up. So all of a sudden, you go like this. No. I'm trying to add more. No, I'm full size. Okay, I'm full size. Okay. All right, you son of a gun. You better break 80. And right now I have 9,000 shares of this at $80, right? I'm in full size. I muscled in with full size. I used all of my buying power. And now this thing needs to break 80. Halt level is 85. So now I'm like, come on. Now, if it doesn't break 80 and it ends up dropping, how much am I going to lose? I'm down 19,000 right now. So now I'm sweating bullets. My heart's pounding. I'm break even on the ask. But I can't unwind a huge position probably on the ask easily, not at the current price and not at the current level of volume. It's choppy. Wait a second. This isn't even a good chart. What am I doing here? I'm already in. Well, I'm going to lose 18,000 at this point. I'm going to lose this much. I might as well just hold it. All right, I'm just going to hold this forever. I guess I own this stock now. I'm going to give this to my kids, my grandkids. This is my legacy right here. This is everything. And so eventually you get to a place where the pain is too great. I can't keep holding this. all I'm seeing is, red on the tape. And finally, okay, all right, you know what, if it breaks 78, I'm gonna have no choice. Oh no, the ask is coming down. It looks like it might break 78. Oh, maybe I'll just keep holding this. Maybe I'll just keep hoping. Now, of course, we're not even looking at the chart right now, but sometimes when you're in this state, you're just so hyper focused on this hope and prayer. Oh no, the bid is going down. The ask is coming down. At this point, you can see, oh, here's girl. Come on in, girl. You can see that this isn't looking good. So, all right, we panic. We sell half. We sell another half. Oh no, it looks like I'm taking the loss. And what did I just lose on that? 18,000. 18,000? I can make that back on GME. All right, I'm in GME. I'm all in. I'm all in GME. I'm up 2,200 bucks. Okay. All right, let's go. GME. I'm all in. Can I use any more buying power? I'm in 2,000 shares. Let's add some more. So another 100 shares. And now what you're doing is emotionally impulsive trading. This is what I call revenge trading. This is snowball trading. Cost is back up. I'm going to cut the loss on GME. I'm going back in costs. Okay, I'm all in costs. Can I add more? No. Can I try to add more? No. Okay, I'm all in costs. Oh, shoot. What did I lose on GME? 10. Oh, my God. Okay, this is bad. And I am telling you that you might think that this could never happen. And, for many of you, maybe it would never happen. Maybe it would never happen because you happen to be wired with more common sense than some others out there. But for those of us that have had this happen, and this happened to me in my 20s a bit, where I would trade and I would get so emotionally impulsive and I would get so angry because the emotional pain of being red on the day and being red this much was so great that I couldn't possibly, I would rather be down 50,000 or take that risk knowing that at least I had the chance of getting back to break even, because being break even or green is exponentially a better feeling than red. If you're red 20 or you're red 30, what's the difference? You're red. That's what that emotional gambler part of you will say. Now, fortunately, some of you don't have this sickness, but for those that do, it's something that you have to be very careful with. And so revenge trading, snowball trading. So, now I'm in this and I'm, in the same position essentially as before, where now I just got back in and it's doing the same thing. If I could get back from where I was at, but I sold it. And so now I'm back in, and now it needs to go to 85 for me first to make back the 20 and then the 30, or, I'm down 29,000. And it could have happened that fast with real money, which has happened. So there are some things that we can do to kind of create some thresholds. And one of them that we've already talked about is calling LightSpeed, calling your broker and saying, hey, Rob, if I'm ever down more than this amount, cut me off. Now, it is your account. It's your money. So if you call him and, in the heat of the moment, you say, hey, Rob, increase my max loss. They can go in and they can change it. It takes them some time to do it. And hopefully by the time they've done it, you will have calmed down enough to, cool off and say, all right, that maybe I shouldn't keep going here. But I've had days where I've had a max loss set. I then increased my max loss, and then next thing I know, I've doubled it, and I'm like, why did I do that? But you know what? Unfortunately, there are a few times where you put it all on black with really just only emotion behind the trade, and it pays off. And the one time it pays off, unfortunately, teaches you a very dangerous lesson, which is that sometimes you get rewarded for breaking all the rules. Not to get too deep into trader psychology, because there's a place for that later in the class, but just again to emphasize that sometimes as a trader, your biggest struggle, the biggest battle is the battle with your own emotions. So that fear of loss, the inability to process and to emotionally handle a loss, these fears can cause you to trade in order to alleviate the fear. So what's happening in this example right here, just to articulate it a little bit more, is that I am so afraid of closing the day red because of what that means about me. It means that I'm a loser. It means that I'm a failure. It means that I'm a, piece of crap. It means I've failed everything. In my case, it means I've let down my father because my account is the money that he left me. And the pain of living with that is so strong that I'll do almost anything to try to finish the day green, including, buying 9,000 shares of some stupid stock. Now, I'm not at a place where, I'm just giving you examples. I'm not in a place in my trading where I get to that level anymore. But it did happen early on for me in my first couple of years, because in my first couple of years, the emotions were a lot higher because I wasn't profitable yet. So, so I'm speaking, trying to remember the place that I was in that might be more similar to some of you right now who aren't able to say, Ross, listen, I made $5 million last year. I can afford being down 150 grand or 100 grand, like, today. That's very different. But when you're at the beginning of the learning curve, the pressure feels higher, the emotional stakes are higher. And so unfortunately, all of that can lend itself to more erratic trading behavior, which can be really detrimental. And then in a situation like this, now it's at 79, I'm down another 15 grand, 78.50. Oh no. And what am I going to do? How am I going to unwind 9,000 shares? Am I going to hit the bid? I'm going to get slippage on it. And next thing you know, all right, I'm cutting the loss. And what is it? How much am I down right now? $52,000. And your eyes would pop. I mean, it's like, I can't believe I just did that. That could have all happened with real money. And it has happened to people with real money. So being able, and that's when it's time to give our old buddy Ted a call and schedule a session with Ted and try to get yourself dialed in. So there's Ted and Diane. But if you've ever had that happen, you just have to be really careful about not letting it happen again and putting some restrictions on your account to prevent it. So the fear of missing out can be equally painful, seeing stocks make huge moves and knowing that you've missed the whole thing. I was the guy yesterday that was red on GBR. GBR made this incredible move and I kind of FOMO'd into it. I was up so much on the day and everything was ripping. I was like, sometimes when you're doing really well, you can get sloppy. And I bought a huge position on it here at 18 as it popped up right there. I stopped out down here. It rips back up here. And you know what? It's just a stupid trade. It was not a good trade. We all will at times fall victim to getting a little sloppy and this and that. But it's important to try to have the mindfulness that this is happening. Therefore, this is a time for me to slow down. So is there a way that you could learn to capitalize on FOMO instead of fall victim to it? I think it's fair to say that we're in a market right now where FOMO is running pretty strong. You've got this crazy move on GBR right here. You've got the crazy move on GME. You've got the crazy move on costs. It is market wide. And so when we're seeing these heightened levels of emotion in the market, it is reasonable to expect, therefore, that the stocks that start to pop up might make even bigger moves. This could be a hard time for trading when you're focusing on just that 10-cent goal, because some of these are just so wild and so fast that you're up or down 50 cents before you know it. And so sizing down your share size would certainly make sense and continue to focus on highest quality setups. But in these markets, what it means to capitalize on FOMO and not fall victim to it is that you're trading the stocks as they're moving up. You recognize that, euphoria and greed and FOMO are fueling this market. You understand that, and you understand the current condition of the market is crazy, irrationally strong, and that you can capitalize on it by taking good quality entries and locking up the profit as it squeezes higher and then looking for the next pullback and not falling victim to it, which is just kind of jumping in with no rhyme or reason. And a reminder on social media, all forms of social media, whether it's Twitter or Reddit or whatever, the old expression, Twitter traders never lose. And people have been saying that for a long time because, you just had those people that put P&L, hey, I could post this P&L right here. And, let's say I was up 52,000 and someone would be like, whoa, you made a ton of money. Well, it's a simulator. Well, maybe you don't tell them that. Maybe you just want to feel good about yourself and you want to get a bunch of thumbs up on your post. And people do that. And, it's people put out the image of themselves that they want people to see. And that may be, in some cases, a very wildly successful trader when the reality is a little bit, different from that. So when you start getting into comparing yourself to other people, you have to remember that you don't really know where anyone else is at. And what they say, for some people, there are some people out there who are very transparent, but the general, I think, community of people out there that post things on social media would be that you have to take it with a grain of salt. Another level of risk is improper position sizing. So I've developed a strategy where I'm as aggressive as I possibly can be, but then I'll only trade the best quality setups. So rather than trading kind of everything that's moving with small share size, I focus on trading the best stocks with the biggest share size. So again, concentrating my attention to the one or two stocks, being as aggressive as possible. And then for whatever reason, if those stocks are out of play, like today, what happened on GME, and I have to switch my focus to something else, I switch my focus to something else. So adopting the strategy of trading A quality setups, I find to be really, really helpful in getting myself dialed in and recentered anytime I'm having a little bit of an issue of feeling sloppy. Now, I do sometimes find a way of finding an A quality setup every single day. So I kind of will trade the best of whatever we have each day, even though A quality today may have exponentially more potential than A quality in a cold market. And so that's where we also have to be mindful, because if I did exactly what I did today during a cold market, I would have lost money. I would have lost a lot of money probably. So what you do in one market is not necessarily, what you want to do in another market. So being able to properly position yourself to capitalize on the right setups, to size down on riskier setups or to not trade them at all, and to be able to size up and down based on the market conditions is very important. So the sugar shack, so growing up in Vermont, being around the maple syrup sugaring industry, you may not realize, but there's a very short window of time where the sap is running. So during the really, really cold winter, the trees store the sap down below in the roots, down below the tree. And then when the weather starts warming up, it's cold at night and it starts warming up, that sap flows up the tree. And so you tap the tree, you drain out, not all that sap, but you drain out some of it, and you boil it down to maple syrup. It's a ratio of about, I think, 40 to 1, 40 gallons of sap to 1 gallon of syrup. So it takes a lot of sap to boil it down. And during the sugaring season, you have this short window of time where you have to collect as much of the sap as possible. And sap will spoil, kind of like milk. So it has to be kept cold and it has to be boiled down as quickly as possible. And so what you'll see if you ever drive around Vermont, and there's a full moon and it's around the sugaring time of year in the early spring, you'll see all through the night the trucks going back and forth, the tractors coming up and down the hill, and the steam coming out of the sugar shack. They have this window of time to capitalize. And if they don't make the very, very most of it, well, they got to wait till next winter, next spring. And so I think from a trading perspective, that speaks to me to the need to capitalize on hot markets, and then the willingness to realize when the market is cold. And I struggle with that. I would love to be able to make, X amount, if I can make $5,000 a day every single day for 250 trading days a year, that's $1 million a year. I'd be perfectly happy with that, but that'll probably never happen. What will happen is I'll have, a week where I make 250,000, and then a month where I only make 20 grand, and then another week later in the year where I make 300,000, and then another 6-week period where I only make 40 grand. And it's just the ebb and the flow of the market. So sometimes that's hard for a beginner trader because you may not have a large enough account to really fully capitalize on a hot market. And so you feel like, well, I only have $1,000 in my account, so I always trade with 1,000 shares or whatever it is, $1,000 a trade or whatever. So yeah, the market was really hot. I was making $150 a day, but the market's cold now. I still want to try to make my $100 a day, but it's not the right market. And so this speaks to the fortunate position that you find yourself in when you start having a larger account, and you can start to scale up and be more aggressive during the hot streaks, which then allows you to carry that over longer. And so think of that as someone out there collecting syrup and all they have is one tree tapped. Well, it's just impossible for them to do nearly as well as someone who's got, more resources. And I understand that that's frustrating, especially for a beginner, because you may not have the ability to make as much as I would make in a hot market. In the hottest market, you still only have the $1,000 account, but I would encourage you to continue to focus on refining your skill. Trading through cold markets only makes you a better trader if you can manage your risk and manage your emotions. And then as you gain experience and your account grows, you can capitalize better and better. So each day, part of risk management is building a cushion. And I talked about this a little bit when I showed you my P&L about how typically I think I showed you this anyways, how typically I make less money in the beginning of the week and more money as we go into the middle of the week. And that's because it's very important for me to build a cushion on the day before I get aggressive. It's important for me to build a cushion on the month before I get aggressive. And it's usually important for me to build a cushion on the year before I get aggressive. So as you can imagine, having a cushion feels great, doesn't it? It feels so good when you have a cushion on the day. Well, it also turns out that the drive to get that cushion can sometimes be so strong that it'll encourage you to take a kind of risky trade early in the day because it just feels so great to have that cushion. And unfortunately, that's even stronger at the beginning of the month because then the whole month is smooth sailing. And it's even stronger at the beginning of the year. And that led me into a 2-week red streak starting at the beginning of the new month, the new week, the new month, the new year. But each day and each week, I do try to start with a cushion. So let's look here at days and times. So Mondays, then Tuesdays, then Thursdays, Wednesdays, and Thursdays. As the days go on, and I've got more profit from earlier in the week, I feel more comfortable, bigger cushion, I can take more risk. So until I've got my cushion, I usually won't feel comfortable taking a high-risk trade. So the riskiest part of every trading day for me, in fact, is the first trade. Because if the first trade goes wrong, then I'm looking at potentially hitting my max loss. The first trade goes right, now I'm starting to build a cushion. Once I have a cushion, the trades inherently carry less risk because profits, I'm trading with money that's on the house. You know, I'm already up $300. So worst case scenario, I end the day zero. That's not bad. And then if I ever go from up 300 to red 300, that's when I start to get upset. So building a cushion and then trying to set the stop at break even. We got to let the tires warm up. Yeah, take a couple of laps around the track. Let the tires warm up before you try to set a record lap time. Get a feel for the market. As you already understand, we've already talked about P&L, profit-loss ratios, no doubt reflect your personal style of trading. So I'm not going to harp on this because we've already talked about it a lot, but it's something for you to be mindful of as you're looking at your metrics either in TraderView or in a simulator and you're saying, boy, my accuracy is not great. That's a problem, right? I mean, I'm making money, so is it a problem? Well, not necessarily. If you're making money and you've got a good profit-loss ratio. So go with what works for you. Sometimes in trading, the best trade is no trade at all, and that's always hard, but cash is a position. And if it's not worth it, if there's nothing that's really meeting your risk profile, you've got to just say that's it. Now, the second level, of risk management is that you can reduce your risk in trading by trading the strongest stocks. So when we get into chapter 3, we're going to be talking about stock selection. Trading the strongest stocks is risk management. Inevitably, if you start trading really risky stocks, whether it's penny stocks or whatever it is, you're increasing your risk exponentially, right? So let's reduce that risk exponentially and focus on the strongest stocks to trade. And then once you understand the strongest stocks to trade, then from there, we're going to focus on the best places to buy the strongest stocks to trade. And then we'll be talking about the setups, the red to green moves, the ABCD patterns, the dip trades. And there's a bunch of different setups that we're going to get into. But let's keep moving forward. Chapter 3 coming up next on stock selection. All right, so everyone going through this class in learning management software, do the quiz at the end here of chapter 2, and then we'll continue on into chapter 3.